Welcome to the daily update, where I'll go over the action in the market for Tuesday, July 16th, and we'll see how things look for Wednesday, July 17th. July 17th. Back in 1977, this little obscure band out of England, known as Led Zeppelin, they made an appearance in Seattle at the Kingdome. Yes, the big toilet. Well, the acoustics weren't all that good, and it was kind of an off night for Zeppelin, but even their off nights were amazing. Before I get into the video, please know that I do have a thing called the SPX Investing Program. It's still free. It's still wide open. I'm going to be locking that down in August. So if you want to go check it out now, please feel free to do that. There are links in the description to take you to videos that you can learn more about the program. There's also a link to take you to the website. Here's an email address if you want to contact me any further about that. Also, the daily video is really the hub of all of the different analysis and commentary that I do. So if you see any of these other videos, it's with the idea of tying into the daily video. So let's go back and talk about what happened and then look at the charts. We did have a higher open and prices pretty kind of chopped higher right after the open. It was really not showing a lot of conviction at that point. We got up to R1 at 56.61. Then we fell back to the 56.50 level, and we chopped sideways some more before climbing back above R1 to close at the intraday high. So the late day selling that was causing me some concern, yeah, it was there. I was noticing it, but it seems to have been dealt with, at least in Tuesday's session. We were up 0.64%, and we were just slightly above average with volume. We are positive in the short, intermediate, and long term. And I have to ask the question, when everything is looking as solid as it is right now, are we looking a little too positive at this point? We're coming out of that time of positive seasonality. The market is getting rather overextended. Pretty much everybody's assuming the market is going to go higher from here. That's when we need to be extra careful, because the market doesn't always like to do what everybody thinks it's going to do. It's about inflation and interest rates, and we are seeing more of a shift as small caps and mid caps continue to improve. That's more of a lower interest rate environment. And I only update this over the weekend, but right now there's about a 99% chance that the market is expecting there'll be a 25 basis point cut at the September meeting. So that's really helping broader areas of the market right now. We're not really seeing growth and value doing all that well, but we're seeing other areas that have been languishing or just kind of chopping around for most of 2024. They're starting to see some improvement. But we still want to keep an eye on all the different geopolitical events. We do have the Republican National Convention happening this week. That's probably not going to have any impact. There's been, of course, what happened last weekend with President Trump. Now he's made his vice president choice, and it's going to be just everybody's great, everybody's wonderful if you're a Republican and you're at the convention. The big night will be Thursday night when he will give his speech, and we'll have to see if there's anything new from that. Not sure if that's really going to have an impact on the market or not. So some comments. The Dow had a really strong day. It's been showing some improvement as well. The S&P set new all-time highs while the small caps outperformed again. And we could also include the mid caps in there too. The mega caps underperformed. It's not like they're falling apart. They're just not really holding the market up the way they were. And the financial sector is looking pretty strong right now. So our list is getting kind of long here for the short term when we're looking extreme positive or overbought. Now, just because we're looking a little too positive, it doesn't mean we're going to turn on a dime here. We just want to be a little extra careful about things right now at this point, because it was just about a year ago. We were just humming along, doing great into about the latter part of July. And then everything looked really, really positive at that time. The market started to be taken for granted, and boom, we ended up having a 10% correction by the time we got into October. May play out different this time, but we just want to respect the market. Even when it appears to be doing everything we want it to do, if we're long the market, we still have to have a healthy respect for that. Maybe it won't always do that. But on the short term list here, We had the ADX, the short-term ADX chart, and now we're looking at the 19-day advanced decline ratio, the blue line. It's getting extreme. The 20-period exponential moving average, that's measured just on the S&P itself. The Williams percent R, the Stochc RSI hasn't shown up yet. It's not quite as happy right now. The CCI 14 and 20, as well as the stochastics, we're still getting far away from that 20-period moving average as measured by the boom indicator, and the short-term RSI based on 9 periods. Also seeing a bit longer list here with the intermediate term ADX. That's the one I focus on the most. Accumulation distribution, even though it doesn't really look like it, it's still measuring that we're far away from the moving average, even though both are going up again. The 50-period moving average, just based on the S&P, the standard deviations chart, and now we're seeing the S&P and NYSE McClellan oscillator starting to look extreme positive. The Swenlin trading oscillator, just based on price, it's slowing down a little bit right now based on volume. The PMO studies, just that one study that we look at that I'll go through here, the Sean trend meter and the boom based on 50 periods, we're getting far away still from that 50-period moving average. The percent B is right on the border of looking extreme positive. And then the more intermediate term RSI based on 14 periods. And then even the 150 and 200 are starting to get extreme here. And a lot of these negative divergences, as I go through the charts, you'll see that they're kind of going away now. Some of them are still there, but the fact that we're continuing to go up is taking care of a lot of these negative divergences that we've been concerned about for a while. And as I said, it looks like at least the market is anticipating that there will be a rate cut. Now, back in days gone by, it was the market that led the Fed. And if that is returning, or if that's what happens this time, and if we still have a high probability of a rate cut in September, then that's probably what should happen. Instead of the Fed leading the market, which has been what we've seen pretty much over the last few years anyway. And we'll have to see, are we even going to get this rate cut in 2024? It's not a certainty. The market may think so, but reality may come in and actually change that. The dollar index was unchanged on the day, and interest rates were down. That's also helping small and mid caps, with the 10-year yield closing at 4.17%, where it had been at 4.23%. We're still inverted with the yield curves. We're positive with sentiment. We're coming in at 64, where we had been at 62. We're positive with our trend. In fact, maybe looking a little too positive. We're above the moving average, both on the short and intermediate term chart. We are above 40. That's when we start to look extreme. With the update, the bias is positive and the momentum is positive. The reports that we got, and I have a whole list here, but only retail sales. I think there's one other one that I look at here where this was actually stronger than expected. Even though retail sales were unchanged, they expected it to be down 0.1%, or last time it was up 0.3%. And this is suggesting that the U.S. economy is hanging in there from a retail sales perspective. When you take out autos, we were still up 0.4%, which was double the 0.2% they had expected and up from 0.1%. Then this is, I don't have charts of these, where import prices were unchanged. Last time they were down 0.3%. When you take out oil, they were up 0.2%, where last time they were down 0.3%. Export prices were down 0.5%. Last time they were down 0.7%. Take out agriculture products and things, they were down 0.6%. Last time down 0.8%. Business inventories up 0.5%, more than the 0.3% they had expected. And we did see it being up 0.3% last time. Then I do have a chart of this, the NAHB housing market index at 42, less than the 44 they had expected. And we kind of split the difference, where last time we saw a reading of 43. So here are the core retail sales year over year, just kind of flattening out, but not turning negative necessarily. And then month over month, we are seeing, they actually showed a little bit of a decrease here, where when you round the numbers, it came in at 0. So we're kind of leaning a little bit to the negative side. And then here's the NAHB housing market index, where it's been coming down. So we're just not seeing an awful lot of strength, according to this chart, with the housing market right now. Here's some Isabel Net blog charts. Here's the technical score. We are overbought. We're getting above 90 right now. And this was even before Tuesday's session. And we have been seeing kind of a long list of our extreme positive indicators. So this is where we want to be a little bit more careful. Doesn't mean we'll stop right here. Doesn't mean we can't still go higher. We just want to respect what the market can do sometimes. And then the mega cap growth and tech positioning starting to get a little extreme here. That was the big trade to be in and positions to be in. And so a lot of folks were chasing that. We're starting to get to an extreme reading here again. And then look at the unemployment rate on a monthly basis here. And I'm not going to go through this. This just measures unemployment with what the Fed was doing at any given time. Is that what it was at the Fed? Okay, it just talks about how many months all of this ended up taking place. And then they have a momentum oscillator down here as well, because that's kind of what we're watching now. The rest of the economy seems to be okay. Now, that's stock market economy, not my life economy. There's a real disconnect between the two. Then we look at the risk appetite, folks. This could actually be positive on the market. Over the next 30 days, they're actually looking at assuming less risk. So there are greater risk aversion processes going on. And they actually expect the market to go down. So based on this, that could end up being positive, since the market will often do the opposite of what people think it's going to do. The consolidated equity positioning coming up here to the one level, but not necessarily extreme based on this chart. Investment grade bonds are seeing inflows again, as there's the potential that interest rates have topped out if the Fed starts cutting rates. And so people are starting to put their money back into the higher quality bonds. And regional banks. Now, I have another chart to show you because this chart's a few days old, lowest since 2009. Okay, fine. That's where they ended up bottoming here. But we're seeing a real improvement over the last couple of trading days with this ratio, but we need to see more with that. And then our forecasts imply a beat of 6.4%, continuing the pattern over the last 5 quarters of beats running along the historical average of 5%. Okay, this is Deutsche Bank, where even though they're coming down here, they still think that as earnings are coming out, that they're going to be better than expected, which could be positive for the market. But that doesn't always guarantee that the stock's going to skyrocket if they do have a really good report. It's also, what are they going to say looking forward? And then earnings per now, what's actually helping things go? And this tries to break that down. Earnings per share, well, that's really what we saw back here. That's the dark blue. Back in 2021, zero interest rate environment, massive stimulus coming in, all these COVID ideas, rules, regulations being lessened, companies just totally benefiting. Yeah, okay, that really helped stock prices go up then. Then it carried over a bit into 2022, even though that was not a very good year for the stock market. Then we started to shift over to more of a valuation basis. And yeah, we've been overvalued, but the earnings per share has kept us not too far above that 20 level on a PE ratio basis, but sometimes we're actually below it. And that's really helped things, where we're still seeing valuations here, as well as a pickup in earnings again, which have been helping stocks to go higher. I didn't find anything interesting on Twitter. A lot of just gobbledygook there. So looking at the intraday chart, this is what was concerning me. The sell-off on Friday and then a real drawdown on Monday, an attempted bounce, and then selling coming in and closing right at pretty much at the low on Monday. I didn't like the look of that. Well, maybe we've taken care of that now. We came up here. We didn't see any real strength. We saw a lot of the thrust up right at the open. We tried to get above R1, came back down, chopped sideways, got back above R1, and then did see some buying going into the close here. So that looks a little better than it had been looking. And here's our intraday chart right here. Really not much to show. There wasn't really a big change going on there. And we are now starting to see value outperforming growth. Not necessarily the end of the world, but when the big companies are really leading things higher, we typically will see the blue line above the red line. And we're seeing the growth to value ratio going down now. If you remember back to late June into July, when it seemed like the big stocks were really leading things up, well, we saw this ratio going up. Now we're seeing that starting to trail off. Not the end of the world, but just something to be aware of. Our end of day chart growth was actually down, where value was up, and it was up a lot for the mid caps, but still up less than value. And it was up a lot for small caps, but still less than value there as well. So when we look at our end of day charts, the growth to value ratios not improving, with the mid caps not improving, and with the S&P starting to come back down. And our ratio between growth and value with the ETFs is starting to come down further into the rainbow. This is where we're seeing an improvement too. Discretionary is showing a little bit of strength here. Staples are not really doing all that much, so that's causing the ratio to go up. And this is a more positive look here. When discretionary is actually outperforming staples, it's not because staples are underperforming discretionary. And large cap growth, yeah, still hanging in there, doing well, not setting all-time highs, but the chart still looks really solid. And we're still going down here. When we do the ratio between large caps and small caps, that's because we're seeing things going out into the small and mid cap arena. The Wilshire set a all-time high. That's a broad market measure. And here's our ADX. This is the intermediate term chart that I look at first. And we're just getting up to very, very high readings here. But the green line's still going down. So that's a little bit of a concern. Here we are. The chart looks really solid here. We see higher highs, higher lows, setting an all-time high with the S&P, but we're seeing the green line coming down. Also, we're declining with the short-term ADX, and this is getting to a very, very high reading too. That big run-up that we saw into late 2023, these are the really high readings that we saw then. But then you look at what happened after that, it didn't mean the end of the world. It just means, okay, we might have some kind of a pullback. And then this recovered, and then we ended up going higher after that. So it's not necessarily predicting some kind of reversal. It just might mean a pullback. And then that's when we fall back and evaluate things. If we start to see something like that, is it just a pullback? The bears are going to be saying, here comes the end of the world. But we'll just be evaluating it to see what kind of intensity there is, if that even ends up happening. And then we were just a little bit above average with volume, but still lately we've been below average. And we're coming into below average times for the NYSE and the NASDAQ. And this is usually what I go over in the weekend, but we're not necessarily in an extreme reading. We are coming up. When we get above this 30 level, this is the individual investors. And when they get above 30, that's when they're starting to look a little too positive for the time being. And the Ulcer Index is showing there's no fear. We haven't received the latest investors' intelligence yet. We're actually going up with the VIX. Interesting. We're going up, and we're kind of seeing that potential seasonal shift where the VIX starts to go higher here, where we closed a little bit up with the line chart as well as the bar chart, and we're going back above the moving averages. And the VIX of the VIX is also ticked down on a closing basis, but we spent most of the day above the moving averages with the bar chart, where the momentum of the VIX continues to be up. Here's the seasonal chart that I've been talking about. At some point in here, seasonally anyway, we tend to start going back up with the VIX, but we'll have to see that actually play out. The skew index is no longer extreme, so it's come down from this red area, and maybe that was the big move that the market had been expecting. But with this chart, we shot back up above this dashed line. This is more like the VIX. When we get a really high reading here, quite often that marks some kind of a decline. Not always, but we want to keep an eye on this since we're getting another extreme reading. But we could still go up more than this reading that we're getting right now. We are going down with the equity put call ratio on the 1-day chart. We're declining and getting extreme with the 5-day chart. And here is a longer term look where we're heading below this green line here. Now we could still go lower than this if the market still has more room to go up. And the 10-day is also declining. So that's more positive across the board with the 5 and 10-day and even the daily chart all declining. That is more of a positive backdrop for the market. And here's the high beta to low beta ratio starting to go up again here and breaking out above these previous readings that we saw at the end of 2023, and then when we were really moving up earlier in the year. And we're going back up again here with the volatility risk premium, but we're still well above this band for the time being as well. We declined with this fear gauge, and we also declined with the other fear gauge. So that's more of a confirmation. And looking at the risk on to risk off, it's not really breaking out here because we're seeing more of the broad market participate in this upward move. And so we're not really seeing this ratio going up with any vengeance. The advanced decline line showing a lot of improvement here, still breaking out above this previous high based on price. The volume is still going up too. So when we look at the S&P from this internal measure, that's still looking pretty solid. And we're just busting out here with the new highs minus the new lows, trying to turn back up with the 5 period and already going up with the 10 period. Another internal measure that's looking pretty solid. And with the 19-day advanced decline ratio coming up into this extreme reading, but it's still positive, and we're going up with the red line, which is the 39 period. And this is the one where the boom indicator, see, you can look at this and see it's not very far from the moving average, but the boom indicator is measuring like it is. So it might be just some kind of a discrepancy going on here, but we're still positive with the accumulation distribution and now starting to turn back up. But according to the boom indicator, maybe a little too positive. This is a concern, though. We're still declining with the chicken money flow with the moving average, even though we were flat with the reading itself from Monday to Tuesday. And we came almost down and we're getting ready to turn negative with the chicken oscillator. And now we just ticked back up. And looking good here with the cumulative advanced decline line for the NYSE, just fly me to the moon. And the advanced decline line is also looking really solid currently. This other NYSE advanced decline line also looking solid and breaking out above previous highs. And then we break it down with the common stock on the NYSE based on price, breaking out above this previous high, already been breaking out when we look at this based on volume. So this is some much improved settings and observations that we're making. Also, when we look at the S&P advanced decline line, cumulative, breaking out above the previous high, continuing to really go up based on volume. NYSE advanced decline line, coming back up and starting to perform much better when compared to the S&P. Looking better here with the advanced decline line studies, pretty much across the board with the NYSE common stock, S&P mid caps, and small caps. Daily chart still looking pretty good. When you take these bars together, they're holding up and doing all right. We do have some overhead resistance at this pivot point. On the bottom, we were just barely above the moving average with volume there. We're extreme with the Williams percent R, extreme with the CCI 14 as well as 20, extreme with the stochastics in the short, intermediate, and long term. Still looking good here with our 20 period moving average study with the double and triple exponential moving averages. The lines are going up and prices above both lines. Getting rather extreme with the 20, just barely extreme with the 50, and still improving with the 200. Now that's just on the S&P itself. The force index is above the midpoint and going up. That's positive. And we're looking really solid here with our regular moving average study based on 20 periods. Still in that +3 channel, meaning that we're a little extreme there with the Keltner bands. And we're getting kind of far away from the 20 and 50 moving averages, and we're still showing an improvement on the distance from the 200. And we're going up with the balance of power. That's positive. Trending, we're still looking positive. Still looking good with the highest high value. TTM squeeze, turning back and looking a little more positive. We had been the darker blue. We're changing back over to the lighter blue, and this is starting to tick back up. The 50 period double and triple exponential moving averages still looking solid. The red line's above the blue and prices above both lines. Ease of movement is looking positive, ticking back up after being extreme with the Erin indicator, and then it fell. And this is where we're looking pretty extreme too with the S&P McClellan oscillator. We're above the 60 level now. It could stay up here for a while, and it can do that during really positive times. But we were seeing that negative divergence. Now that's pretty much been taken away. We're also going back up with the summation index based on price and volume. So that's still looking pretty positive there. getting extreme with the NYSE McClellan oscillator and pretty much have negated this negative divergence. Going up with the summation index based on price and volume for the NYSE. Getting extreme with the Swenlin trading oscillator based on price. Still going up, but not showing an awful lot of strength right now with the Swenlin trading oscillator based on volume. And momentum is still positive and possibly looking extreme positive with the PMO. We're going up with price and volume. And we're getting extreme with the PMOs that are rising. We're going up with the buy signals, going up with the PMOs that are above zero. So, I mean, we're looking really solid right now. And that's when you get a little, at least that's when I get a little bit nervous here. We are positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. The slope is starting to go back up and possibly extreme positive. The MACD is still looking pretty good. So in the short, and we're starting to turn back up here with the TSI, the other short-term oscillator. Intermediate term looking good, and also seeing an improvement here with the KST, and the tricks are also positive. So now we're seeing more across the board positive readings here, but some of them may be getting a little too positive. Above all the plotted moving averages here, and the bullish percent index continues to improve and is not extreme yet. The NYSE bullish percent index is also improving, and the NASDAQ 100 bullish percent index. It was pretty much flat, but it's still positive. The money flow is positive. The ultimate oscillator is fine. It's not going up, but it stopped going down for some reason there. And we're just on the border here with the percent B indicator. We closed right at the upper Bollinger Band. The vortex is continuing to show some improvement. The RSI 14 and 9 are extreme positive. The on-balance volume is positive. We're coming back down with the standard deviation over the last 10 periods, but we're still above the moving average. And we're getting extreme with those stocks above their 20-period moving averages in the S&P, and pretty much taking care of this negative divergence that we had been seeing. Also looking good with our study here. We're well above 70. We'll have to see if that's going to see more follow-through action. And then those stocks above their 50-day moving average. Still seeing the longer-term negative divergence here, but really improving. And kind of going flat here with those stocks above their 100-day moving average, still seeing that longer-term negative divergence. And we're going up with those stocks above their 200-day moving average and almost getting to that 80% level here. But we still have this negative divergence in here. If we keep going up, that may get dealt with. The copy curve is turning back and looking more positive. We're still flat with the Sean trend meter, but we're extreme positive at the same time. The rate of change going back 50 periods is still above that red line, looking rather extreme. Looking good here. When we take a broad market measure of the 5-period moving average of the highs minus the lows, and we're still looking really good here with our weekly chart of the S&P, well above that R2 level. And we're starting to break above the 61.8% fib extension here, and that could be positive. This had been producing a little bit of overhead resistance. We might be able to break above that. On a trending basis, we're just still looking really solid with the Heiken Ashi, with the Kigi chart, the Renko chart, and the 3-line break chart. Long term, showing an improvement here with the 150 and 200, but still seeing these longer term negative divergences. But we're extreme with both of those moving averages. The rate of change going back 200 periods. Haven't seen this in quite a while, and we're getting above this blue line. That's longer term. And then we're positive on all the time frames, on all the different indexes according to the Keller market model. We're still negative with bonds in the long term, negative with commodities in the short term, negative with the dollar in the short and intermediate term. Still positive across the board with the decision point scorecard. And I saw a little bit of Christmas lighting going on here, but an awful lot of positive things with the S&P eventually setting a new all-time high. And looking at the sectors, there was only one sector that was down, and that was tech. And tech's been the stronger area. So we're still seeing that rotation going on for the time being. And we're looking better here with the NYSE new highs minus the new lows. The black EKG looking thing, that's just the raw score from one day to the next. The red line is a 50-period exponential moving average. And looking better here when we compare the equal weight with the S&P. So the ratio is continuing to come down, which in this context is not necessarily a bad thing. It's really nice when there's a few stocks really driving the S&P higher and the rest of the market's languishing. Well, it's not that the mega caps are falling apart. They're just kind of taking a breather now while the rest of the market is trying to catch up. This is also showing an improvement. The Dow and transports, the red line's starting to come back up. Even though the Dow's been breaking out, we are seeing a bit of an improvement with the transports. That would be more encouraging. And the Dow just busting out, setting an all-time high, broke above this R2 level. The diamonds are positive with the Elder's Impulse system. And see how we're just kind of not breaking out, setting new all-time highs here with the NASDAQ. It's not that it's fallen apart and we're still above this pivot point, but this has been the leadership area and it seems to be taking a rest right now. And we're kind of seeing that same thing with the NASDAQ 100. And the Qs still remain neutral with the Elder's Impulse system. This is a concern. We're turning a little bit further below the moving average when we look at the momentum for the NASDAQ 100. And we came up to this 50% extension level, and so far we've not been able to get back above that. So that's still acting, at least this area anyway, is acting as overhead resistance. This is more encouraging. With the equal weight, we're finally setting a new all-time high here. We're setting recent all-time highs here with the QQQ equal weight as well. So that's a confirmation now. The small caps just rip roaring up, but beware. We saw this back in November and into December. Just fly me to the moon, Frank Sinatra style, and then everything just kind of stopped and went sideways. Now, is this time going to be different? We don't know that yet. We just want to be aware of this. And the Elder's Impulse system for the small caps is positive. And even the Russell 2000 small caps looking really solid right now, really, really extreme with the RSI. The momentum continues to be positive. And then I wanted to show this, and I usually wait and show this over the weekend in the intermarket analysis video. This is a ratio from the small caps to the S&P 500. Even though they're bouncing back up, we still have a longer term trend that needs to be dealt with. So again, one thing to consider is, yeah, the small caps are doing really well, but they're not really consistently outperforming the S&P, at least yet. We want to see this continue to go up and eventually see the blue line cross above the red line. The mid caps also looking pretty solid, breaking above the R2 level and positive with the Elder's Impulse system and setting another new all-time high with the total US stock ETF. Apple was up just a little bit, but still looking solid. Tesla was up 1.5% and hanging in there a little bit, still above both of those moving averages. We might get to the point of seeing a golden cross here with the longer term trend. Nvidia was down 1.62% as it's been chopping more or less sideways. It's interesting where we saw a little nice run up at the beginning of the year and then it kind of went sideways and drifted lower. That ended up being some kind of a basing pattern, and then earnings came out and that shot it up, and now we could be going through some kind of a basing pattern again, which is more of a sideways to slightly down type of action here, but we're still looking very solid with Nvidia. Microsoft was down almost 1%, but still above its 50-day moving average. Meta still coming back down and dealing with its 50-day moving average. Amazon was up slightly. And Google also was down 1.4%, but still above its 50-day moving average. Netflix was virtually unchanged and kind of dealing with its 50-day moving average. The FANG index just chopping more or less sideways. This had been the real leader earlier on. It's not falling apart, but it is slowing down. The financial sector looking really solid right now. And the staples to tech ratio bounced up just a little bit, but overall we continue to decline, and that's positive for the market. The dollar ended up being up slightly here, at least in the after hour session, but we have been dropping off, but it was unchanged, at least during the session on Tuesday. And still seeing a pretty strong correlation when we look at the S&P to international stocks, but we're still dropping off when we look at the longer term correlation. Just keeping an eye on the staples sector, it was up almost 1% and still above its 50-day moving average, still looking pretty solid when we look at it independently. Utilities also up 0.78% and above its 50-day moving average. Real estate, seeing a little bit of love here, finally starting to break out above these previous levels. And healthcare is also breaking out right now. These are more defensive areas. Energy finally was able to get above for 2 days now and stay above its 50-day moving average. And here's the bank ETF, which is just looking pretty solid right now. And this is the ratio between the financials and the S&P. Now, financials have been doing quite well, but they've still been underperforming the S&P enough to give us a death cross here with this ratio. And another ratio we've been watching are the regional banks. These are the banks that are assumed to be at more risk. And we compare it to the financial sector. We are seeing an improvement here, but we're going to have to see more to see this ratio have a golden cross. We were pretty much, we were down with the 10-year here, 10-year yield. We were up with the 10-year based on price. We are seeing this ratio continue to decline, which is positive for the market. This is 1 to 3 month versus 3 to 7 year bonds and taking a ratio. We want this to continue to decline and the rainbow to keep rolling over. Home construction, this is kind of interesting. And we saw this happening while it was happening, coming down to the 250 period moving average and then bouncing up off of that. Still seeing an awful lot of strength with this ratio compared to bonds. The market is completely anticipating a soft landing, and here's an inverse where we continue to decline with bonds underperforming stocks. The broad market also is outperforming shorter term bonds and other broad market measures, outperforming further out bonds. The QQQs, they're ticking back up a little bit as things have been slowing down there in the Qs, but they're still outperforming 3 to 7 year bonds. The tech sector also slowing down a bit now, but still above the rainbow when compared to 3 to 7 year bonds. Not really seeing much of an improvement here with the Qs to S&P growth to value ratio. Discretionary to S&P is showing some improvement, and large cap growth is actually starting to underperform large cap value, but we're still seeing the moving average going up. And with the large caps, we're dropping below the moving average, not seeing much of an improvement with the mid caps and the small caps. This is just like, let's spread it out time and buy whatever we want to buy. We're starting to get extreme with the 19-day advanced decline ratio, still looking positive, but not extreme based on volume. The S&P to utilities ratio continues to go up overall. That's positive. And we're coming down with the 2-year treasury yield, and that's also positive for the S&P. And we're declining with the staples to S&P ratio, which is positive for the S&P there. We want to keep an eye on the Hindenburg-Ullman. We still have not received the confirmation signal, but we have until August 2nd for that to happen. And we're not seeing really much of anything right now with the NASDAQ Hindenburg-Ullman signals. So what's our outlook? We are positive, and the broader market is improving. Now, there's two contexts that I use for the broader market. Broader in the sense of the rest of the stocks in the S&P, and then broader market as those stocks, common stocks anyway, in the NYSE. These negative divergences appear to be going away, at least being dealt with. Are we getting a little too positive? And we're going to get the MBA and NA mortgage applications index, building permits, and housing starts. Those are leading indicators, industrial production and capacity utilization. And then we want to see all the different crazy things going on in the world in case they impact the market. And then on Thursday, we'll get jobless claims and LEI. Not really much coming out as far as what's truly important according to this calendar. Seasonally, we are positive, though. July 17th, we're positive with the Dow, S&P, and NASDAQ. And we're also seeing a little bit of a tick up here during an election year with the green dash line. We still have, at least according to this chart, 1 or 2 days left of some positive seasonality before we come into, well, things are still looking pretty good here. Mainly, we want to follow the election year, where we might see a little bit of downward move for a couple of days. And then later in the month, that's when we start to see some more negative seasonality before we bounce back up going into the end of July. Wednesday is the most negative day of the week, at least how things acted in 2023. Longer term, though, we still look positive throughout the areas of this green box from June through September. And we're wondering, are we still in this little window here for the NASDAQ, or is that window now starting to close? And we still see things a little bit more choppy during a presidential election year, but so far we really haven't seen that. And we're still far away from these other average seasonal measurements here. Is there going to be some kind of an attempt to revert back to the mean? And we're coming out of the first half of July, and now we're starting to go back in, or starting to go into the second half of July. And we're coming up, the 17th now will be the end of this seasonal time, according to Carson. So the warning signs, we're just keeping an eye on the defensive sectors, but the market is really shifting right now. At least it looks that way. We're seeing a number of days. This is what, the fourth trading day that we've really seen this happening now. So it's not just more or less a one-day wonder, but we want to know if it can still continue. But we're still keeping an eye on staples, utilities, and healthcare, and kind of an eye on energy. The growth to value and discretionary to staples ratios, they're not leading right now. Discretionary showed some improvement, but they're not really leading things up for the time being. And then we're worried about the momentum for the NASDAQ 100. Long positive list here. The accumulation distribution, but could be extreme. The chicken money flow is positive, but declining, and the chicken oscillator ticked up, but we're just kind of keeping an eye on that for right now. The parabolic SAR is positive. We're looking at the McClellan oscillators for the S&P and NYSE as being positive, as well as the summation indexes. The bullish percent index is improving, and that's been encouraging. The Swenlin trading oscillator is improving based on price, slowing down a little bit based on volume. Both the 5 and 10 equity put call ratio charts are now going down. In fact, we're starting to get extreme with those. The advanced decline lines are just now positive. They've really been improving. Our oscillators are positive, but some of them, at least in the short to intermediate term, could be getting extreme positive. The Copic curve is positive. Our moving average studies are positive and really improving. The money flow, the ultimate, and the vortex indicators are all positive. We're positive with the NYSE bullish percent index. The financial sector is looking quite positive. And we're still positive with the bullish percent index for the NASDAQ 100. So our conclusion, we're positive, both internally in the S&P and on a broader market sense, we are improving. We just have to ask this question. Doesn't mean we're going to get an answer right away, but are we looking a little too positive? In the short term, we're becoming even more overextended to the upside. You could say overbought. In the intermediate term, that's where we're wondering if we're getting a little too positive right now as we become more overbought. We're looking positive, and the negative divergences in the long term are even showing an improvement. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.